People tend to overestimate their ability to predict the future, and investing is fundamentally about betting on predictions of the future. Past revenue growth, past earnings growth has no predictive power over future earnings growth or future revenue growth. Investing is not a game of analysis, it's a game of meta-analysis. It's not what you think, it's what you think relative to what the rest of the market thinks. Right now is biotech, which has been in a 4-year bear market and where everybody's been sort of flushed out of it. Expensive growth stocks are massively overpriced because then their future is dependent on them growing some massive amount per year. And if we can't predict the future, they're no more likely to grow at that rate than any other stock. So it's crazy to buy them.
Welcome, everyone. I'm speaking with Dan Rasmussen, the founder and CIO of Verdad Advisors, the author of the Humble Investor book, manager of small cap stocks. So thank you very much, Dan, for joining me.
My pleasure. Thanks for having me on, Marius.
Okay, so let's start off with maybe how you got into investing. What is your investing philosophy? And let's start with that.
Yeah, I studied history and literature in college, so it wasn't like I grew up choosing stocks or something. I really had no particular interest in investing up until I needed to get a job, and I wanted a job that paid me for my dad's a lawyer and gets paid by the hour, and he said, gee, wouldn't it be better if you got paid by the decision, not by the hour? And so I was really looking for a job that was sort of betting on ideas. And I love reading, I love research, I love thinking about things. So I was looking for a job, and so I probably at the time could have gone and become a professor, but there wasn't a lot of money in that at the time or now, or gone into investing, which I felt like was sort of a similar applied research, in a way. You're betting on whether your ideas are right or wrong, and I loved that idea. So I ended up getting a job at Bridgewater, an internship at Bridgewater, and then after college I went to work for Bain Capital, private equity. And so I think my sort of style of investing developed professionally by sort of reading and experimentation and learning from other people. But that was sort of what got me into the field.
But do you consider yourself a value investor, growth investor, a combination of both?
Yeah, I'm very much a value investor. And I think that the core of my philosophy and my book, The Humble Investor, is about this idea that people tend to overestimate their ability to predict the future. And investing is fundamentally about betting on predictions of the future, right? You buy a stock because you think the stock price is going to go up. That's a prediction. So what you want to do is study the science of prediction. What do we know about forecasting? What do we know about predicting the future? What do we know specifically about predicting the future of, say, things that matter to investors like earnings growth or revenue growth? And I've, my philosophy really developed from studying these questions. And I would say some of my early findings were when I was working in private equity. I did a big look back at all the forecasts that the firm that I was working at had made about the companies they owned. I found that the future is a lot harder to predict, even with huge diligence budgets and huge investment in trying to predict it, because and there's a great academic article that came out in 2004 called "The Persistence and Predictability of Growth," which we've replicated with data in the latest 20 years, and which is very consistent, which is that past revenue growth, past earnings growth has no predictive power over future earnings growth or future revenue growth. So many people say, "Oh, I'm buying a company that's growing at 20% per year." Well, no, you're buying a company that has grown at 20% per year, but that doesn't mean anything. And so I think my approach to investing has been to say, well, let's almost start from a position of what I call future nihilism, right? Imagine that the future is completely unknowable. We know no one knows anything. Well, then, really expensive growth stocks are massively overpriced because, then their future is dependent on them growing some massive amount per year. And if we can't predict the future, they're no more likely to grow at that rate than any other stock. So it's crazy to buy them. On the other hand, the cheapest of value stocks, the highest, say, dividend yield or free cash flow yield stocks, in turn look like great investments because, hey, we don't know anything about the future, and therefore the most common prediction is just that things stay the same. And if things stay the same and that company continues producing a 15% dividend or a 20% free cash flow or whatever it may be, then you're going to do pretty well. And so I'd say the starting point of my sort of development of my own philosophy of investing was this idea about the future and understanding or starting to understand the degree to which which other investors overestimate their ability to predict the future. And by betting on future nihilism and starting from the premise of humility, you could actually come to a differential view from most investors, and you'd have your views much more grounded in science and research about what works and doesn't than those people that are building, very complex discounted cash flow models.
Okay, so you studied something completely unrelated to investing in school. Then you went to work in the investment industry. But at some point, you went out. You went out on your own, and you started Verdad Advisors. What was that like? Why did you go on your own?
Yeah, and so I think this insight that you can't predict the future, and that building massive earnings growth forecasting models is a waste of time, which was an insight I had quite early on in my career, was not a popular one, nor was it one that made me a particularly good employee at a large investment firm. Right? If your job is to build massive Excel models to predict the future, and you have developed a philosophy that predicting the future through massive Excel models is a complete waste of time. You're going to end up being completely insufferable to work with, and I think I was probably the world's worst employee for a period of time. I got to the point where I sort of thought, well, I'm so bad at this. I seem to piss everybody off. I don't like building these stupid models. Maybe I'm just sort of the most intolerable individual. And if I go work at any big company, everyone's going to immediately start to hate me because I come up with these crazy ideas and piss people off because I don't want to do the work they want me to do, et cetera. So I sort of thought, well, maybe my best hope is to go off on my own because otherwise I'm completely going to get destroyed. So I wouldn't say it was, again, I sort of got into investing not because I had some grand scheme to go into investing, but just it seemed like the best choice at the time. And similarly, starting my own firm, it seemed like the best option open to me given my self-assessment that I was a pretty terrible employee. So I left work at a large private equity firm, and I went to business school at Stanford, and I started Verdad really from my dorm room at Stanford. And the original idea was to buy companies that looked like the best private equity deals. And the best private equity deals have really three things going for them. First, they're microcaps. So, private equity, first and foremost, is a microcap strategy. Just to give you a sense, there are 2,000 companies in the Russell 2000 small cap index, and the Russell 2000 is 2 trillion of market cap, roughly. Private equity is also about 2 trillion of market cap, but there are 12,000 private equity backed companies, right? So it's almost an order of magnitude smaller than small cap. And second, private equity firms borrow money, so most private equity deals are levered, generally about 60% net debt to enterprise value, massively more than public companies. And then third, there's a powerful, or at least was, a very powerful value effect in private equity where the cheapest deals do best. And I think the reason the cheapest deals do best is because you're underwriting sort of the lowest expectations, and so you're the most likely to be surprised to the upside. Whereas the expensive deals, which are expensive with leverage, which is a truly double-headed hydra, you're more likely to be surprised to the downside because you underwrote something so optimistic. So I started getting into buying these, small, cheap, levered micro caps. And when I started, I'd say probably half the opportunity set was in Japan, and another third of it was in Europe, and only about 20% was in the U.S. So I really got focused on international microcap deep value investing. So even more niche, but that's really what I've been doing. And we've grown our business since, but that was sort of the original thesis and what we've been working on since 2014.
When you're talking about microcaps, these are companies that are at the beginning stages of business development, so they don't have the same metrics as mature companies. So you can't really look at free cash flow, PE ratios, whatever. So how do you approach those companies? How do you value them then?
Yeah, so I think it depends on where you're looking, but if you think about most markets, U.S., Europe, Japan are like pyramids. There are a very small number of very big companies, and there are a very large number of very small companies. And of course, if you went down into the private markets, of course there'd be many more thousands of companies, in order of magnitude smaller. And so I think whatever it is that you're looking for, You can find more of it in the small cap. You can find more of it in micro cap than small cap, more of it in small than mid, more of it in mid than large. So yeah, if you want to find really high growth companies, there are a lot of really high growth, early stage companies in the smaller micro cap world. But if you're looking for what I'm looking for, which is actually they're mature businesses, we're not looking for small growing business. We're looking for mature businesses that are, generally growing with GDP, that are extraordinarily cheap, spitting off lots of free cash flow and using that free cash flow to pay down debt. There are hundreds of companies like that in the microcap universe, hundreds in the US, hundreds in Europe, and hundreds in Japan. And so we go and find those companies, and we value them on very simple metrics that are quantifiable: price to book, price to earnings, EV to EBITDA, free cash flow yield. So we care about those sort of valuation metrics, and then we also care about some quality metrics. So we care about a metric which is often unfamiliar to fundamental investors, which is gross profit divided by assets, which is a proxy for return on investment or return on invested capital. But it's a very robust one. And so we're looking for companies that are both cheap and decent quality, and that are GDP growers. And we buy portfolios.
But already profitable.
Yes, of course, have to be profitable, have to be free cash flow generative, have to be profitable.
Okay, so what I see a lot, from the smaller companies, is that some of them will sacrifice profitability because they want to grow, or because maybe they have some disruptive technology that can make them big, so they are burning cash. And then the companies that are already profitable but they are small, let's say example, like a gas station. A gas station is tiny, but it can be profitable. So the companies that you focus on that are already profitable, are they profitable because they don't have a huge growth ahead of themselves, and they are already at that stage, they're small and stable?
Yeah, generally what we're investing in are small and stable, or small and cyclical, but we would never invest in companies that are trying to grow by spending money, by burning cash. That's not our approach. And so I think of broadly what we invest in is, what used to be called in Germany the Mittelstand, the broad middle of companies, right? They're not your sexy brand name businesses, but they're also not small businesses. They're the middle businesses, and they do boring things, right? They make some certain tube that goes into a car, or they make cardboard boxes that you ship your Amazon things in, or they make some generic semiconductor equipment piece that's not a fancy thing, but thing that goes into every semiconductor. So you have all those types of companies that are sort of orphaned, to be honest, Marius. And I think what your question is pointing at is really, why would anyone buy these? I mean, they're not the sort of large dividend payer, cash cows, right? They're much smaller than that. But they're not high growth, so they don't have some great story attached to them. Who cares about cardboard boxes or something like that? And that, in my view, is what creates the opportunity as a value investor, right? That you're buying quality, right? So, in my definition of quality, they're profitable, they're free cash flow generative, they have high return on assets. Maybe they even own a lot of real estate or their own property, plant, and equipment. And yet they're completely neglected because there's nothing that gets anyone excited about these companies, except for me.
That's right.
Because I look at them and say, wow, 15 or 20% free cash flow yield, that's really attractive. This company's going to spit off cash, and I'm going to earn that cash flow. And if they grow with GDP, I'll earn a little bit of growth too. And if I keep sort of systematically going to the countries or sectors or regions where these things are trading abnormally cheap, I'm going to earn a real premium over time, and that's what we've done.
But then how, if those businesses are small and boring, and not they don't have the narrative that's exciting, and you're a business owner, Verdad Advisors is a business, so then how do they not stay cheap forever?
Yeah,
Because you got to make a return.
yeah. So I'd say that's in small cap value investing, at these type of valuations, typically you can think about earning about 12% a year just through free cash flow generation. And we buy levered companies. That typically comes through deleveraging, right? So they're paying off a portion of their debt each year, maybe, and that amount of debt they pay off is about 10, 12% of their market cap each year, right? So we look for that. That becomes a catalyst. And then they're growing with GDP. So if nominal GDP is 3-4%, maybe they're growing 3-4%. So you're getting up to a 15, 16. And that sort of feels like a right return target for us. And then we'd say, okay, but what we really want is a company that's trading 20% below where it normally trades. So, maybe it's a boring company that usually trades at 5 times EBITDA, and now it's trading at 4 times EBITDA. And so instead of earning a 15, we'll earn in the mid 20s because we're going to get multiple appreciation on top of the free cash flow generation. And that's sort of the sweet spot for us, right, where all of those things are true. So what we typically would do is the equity value is going to mechanically increase because of the deleveraging and the dividend. You're going to earn the dividend yield, which is typically a few percent. It's going to grow a few percent, and then hopefully you'll get multiple re-rating on top of that.
Warren Buffett always talks about how if he had less money to work with, he would go on after those obscure opportunities. But your company manages $1 billion. That's not nothing. That's a lot of money to invest in small companies. So does it mean you have to have like hundreds and thousands of them?
No,
for this $1 billion to find home?
No, I think that if you look at sort of a given region, you can generally put a few $100 million to work in micro or small caps. And the way I would think about it, we're going to be more diversified, maybe own, 70, 80 names in a given region. And those names, many of them are trading less than $1 million a day, so they're pretty illiquid. But if you go to sort of 3-4 times daily volume across your names, and you're buying, and then a few of the things are maybe a little bit more liquid, they trade $2 or $3 million a day. You can get to managing a few $100 million in a given region in micro or small caps, but not much more than that, right? So it would be hard for me to manage $1 billion dedicated just to micro caps just in Europe, for example. But I could do 200 or 300 million in Europe, no problem. So I think it's just a matter of sizing the opportunity. I think that sort of size range is roughly right. And then making sure you understand how to trade these things and the liquidity dynamics, and being sufficiently diversified. I think a lot of investors are too concentrated and they should be more diversified.
Mm-hmm. Okay, so for Verdad Advisors, what types of funds do you have? Is it strictly microcap and small caps?
No, we manage a number of different strategies, Marius. So we do microcap, deep value internationally. We do high yield credit, and then we also do multi-asset, long, short, market neutral. So those are our core strategies today. And then we have a cool thing we call crisis investing, which is where we do microcap, deep value, but we only do it during recessions. So we wait until the recession, and then investors send us money during the recession, and we manage the money until the recession's over and give it back, which is basically the idea that micro and small caps do really well coming out of recessions. So if you can buy them in the middle of one, hold them until they come out, you can capture a big premium.
Okay. And at the end of last year in December, you already mentioned you published the book, The Humble Investor. Why this is your second book, but what is this book again about?
So The Humble Investor is laying out my philosophy of investing, and it's discussing this idea of humility. And what that means. And so we've talked about a little bit about future nihilism, or understanding the difficulty of predicting the future, and trying to bet against those who think they can predict the future. But I'll give a story that I start the book with and that I love, which is my colleague Sam Hansen wrote a wonderful paper about the Greek shipping industry. And in the Greek shipping industry, when times are good and shipping rates are high, a Greek ship owner might look out and say, "Wow."
Hold on. What's the title of the book? I think I read it.
This paper that I'm talking about, it's Waves in Ship Prices and Investments is the title of the paper.
Okay,
it's an excellent paper.
Okay.
And so when shipping rates are very high, investors, ship owners go out and say, well, look, if I had twice as many ships, I could make a huge killing. And the ROI on building a ship, if I were able to lease it out at these rents, would be 30-40% a year. So I should go order 5 new ships from the Korean shipyards. So they order the ships from the Korean shipyards, and it takes 3 years to build them. So 3 years later, they get the ships delivered, and the owners call the captains and they say, hey, how's the leasing on these new ships going? What's going on in the market? And the captains call back and they say, well, I'm really sorry to report that shipping prices have cratered. And I said, well, why have shipping prices cratered? When you order these ships, the shipping rates were so good. And I said, well, it turns out there's a glut of new ships on the market. And it turns out that everybody else ordered ships at the same time we did. Sam and his colleague Robin call this competition neglect, right? Which is that at the time you were acting, you failed to realize that other people were acting too. And there's an analog to this in the stock market, or with the idea of efficient markets, which is, so many times you buy a stock and you have a thesis as to why you're buying it, but you don't take into account that other people might have the same thesis. And I like to think that investing is not a game of analysis, it's a game of meta-analysis. It's not what you think, it's what you think relative to what the rest of the market thinks, because you don't want to be like that ship owner who just orders a ship whenever the shipping rates are high, because then you're going to suffer from the same booms and busts that everyone else does. Instead, you need to be a contrarian of thinking, well, where are people not spending money? Where capital is so depleted that there's no supply? And that's where I want to invest. And so I think my first instinct when it comes to investing is to look for those places that are deeply out of favor, and then find high quality, cheap assets in those places that are generating free cash flow and profit, so that I can wait until whatever that market is, perceptions change. And so I'm really focused, and the way I think and the way the humble investor is I'm trying to talk about those markets that are on either extreme, either that they're on the extreme of cheapness, that are very, very interesting at the moment as a result of capital starvation, or on the other hand, that are massively oversaturated with capital and therefore pose a major risk, much like the risk of those Greek shipping owners who buy ships when shipping rates are high. And I think today, broadly, international small cap markets are very attractive, are very cheap. Now they're recovering, so they're less cheap than they were a year ago, less attractive than they were a year ago, but still very attractive relative to certainly to the U.S. One I didn't write about in the book that I think is quite attractive right now is biotech, which has been in a 4-year bear market, and where everybody's been sort of flushed out of it. And that's not a value sector, it's a growth sector, but it's a very attractive sector right now. And I think if you look on the contrast, what are people too optimistic about? Where is there too much money sloshing around? It's the private markets complex, private credit, private equity. And those are markets that are, I think, all right now in the middle stages of a pretty major crisis. And I think institutions and allocators are just starting to realize how much pain they're in, and how much they're going to suffer for taking such big risks in privates.
Okay. Well, thank you for that. My final question is, do you have any final thoughts, and where can people find you on social media?
Yeah, I'm on X. My username is @VerdadCap, and I also have a weekly research email, which you can subscribe to if you see it in my bio on my X page. We're also my email address is dan@verdadcap.com. So if you're at all interested in following our research, please follow me there, and please buy the book, The Humble Investor. It's available on Amazon or anywhere books are sold. And I think it's pretty interesting.
Well, thank you very much.
Thank you, Marius. I appreciate it.